Hello friends, welcome to Nirmal live podcast where we dive into one of the most significant policy shifts in recent years, GST 2.0, and what it means for economy, markets, sectors, and the mutual fund industry. The reforms announced yesterday aims to simplify India's indirect tax structure, streamline compliances, and potentially reshape the way businesses and investors think about the growth. ये एक रिफॉर्म है जो गवर्नमेंट की इंटेंट दिखाता है टुवर्ड्स ईज ऑफ डूइंग बिजनेस एंड इकोनॉमिक एफिशिएंसी। और इसी पे इन डेप्थ पर्सपेक्टिव देने के लिए हमारे साथ हैं मिस्टर राहुल सिंह, सीआईओ टाटा एसेट मैनेजमेंट कंपनी। So, Rahul, quickly, I would like to understand from you what are the key changes introduced yesterday, particularly regarding the GST slab and the structure.
Yes, hi. Good afternoon. So the main change is that the number of slabs obviously have come down to 5% and 18% from earlier four slabs. So a lot of 12% taxation GST rates have come down to 5%. A lot of the 28% items have come down to 18%. The 40% taxation, I think there is some rationalization there, but more or less that on the sin goods, that 40% stays. And there are a lot of cases where the like in health insurance and life insurance, the GST rates in fact have come down to zero from 18%. So these are very significant kind of changes, and I think it's while it was expected, it is on expected lines. There are some positive surprises, and that I think is quite important because this we should not look at it in isolation. I think there was an income tax cut in January in the February budget this year. After that, there have been interest rate cuts. Liquidity has been improved by the central bank, and now this GST rate cut. So if you look at a combination of these three things, I think all these three things are trying to boost consumption in the economy, and I think that is the way we need to, look at it in not just in isolation, but in totality with the other measures which were taken.
Okay, so it means, do you see that this GST 2.0 as a structural shift that strengthened India's tax regime or the financial ecosystem?
Yeah, I think it's a very important step in that sense that we've always been talking about, and the businesses were talking about rationalizing the GST structure, that the indirect taxes were very high in addition to the direct taxes, and that the compliance and some of the processes were a little bit more difficult. So all those things have been taken to the next level, and the rationalization of the rates is very significant because it simplifies and reduces the number of rates. It also reduces the rates to 0 or 5% in a lot of low ticket items like FMCG, or I was mentioning, insurance. Even for automobiles, most of the 80-90% of the automobiles move from 90%, from 28% to 18%. So instead of looking at item by item, I think what is important to understand is that this is a big step in rationalization, the number of tax slabs, and to that extent, it will. I mean, the hope is that this will also boost consumption, and eventually, whatever revenue loss which the government is saying is there, which is about 48,000 crores, will get made up by higher consumption. Typically, that is what we have seen in any tax change. That when the tax gets reduced, typically the consumption boost will take care of the revenue loss over a period of 1-2 years. So I think it has a good multiplier effect on consumption and GDP growth rate, and therefore I think it's a very important step for the economic outlook and the financial ecosystem.
Okay, so Rahul, as you mentioned, there are the shift from multiple GST slabs to normal, two slabs plus a sin a rate. What are the sectors? Few sectors definitely you have mentioned. So just would like to understand are likely to see the most direct impact?
See, obviously, consumer sectors, consumer durables, FMCG, foods, and other FMCG products. Then you have cement, which is a big category, the big consumption item in the country, moving from 28 to 18%. You have other part of the consumer discretionary like white goods and autos, which are moving from 28 to 18%. These are big beneficiaries. Then the beneficiaries are more in terms of the healthcare sector, where both the insurance as well as on certain medical inputs, the rates have come down to either 0 or 5%. I think that's another big kind of sector which is beneficiary of this. And the third aspect of this is that there will be indirect beneficiaries of whatever the government is trying to do in terms of the consumption growth and in terms of the credit growth. So I think all the retail banks, the retail focused banks, as well as NBFCs who have a big retail book or retail lending book, I think those are the companies which will benefit in terms of growth going forward. So there are direct beneficiaries, as I mentioned, for the consumer sector, cement, autos, healthcare, and then there are indirect beneficiaries like banking, retail banks, and NBFCs.
Okay. It's about, mostly we have talked about, how it is going to impact on the sectors in the economy. At the same time, under this law, how are state revenues expected to shape up? And do you foresee any kind of a risk or shortfall in a state level fiscal planning?
Yeah, I think the shortfall can happen if consumption does not revive. I think here the effort is that, or the assumption is that eventually there will be revival in consumption, and that will take care of the shortfall. I think it typically will take 1 or 2 years for that shortfall to kind of get recovered. So maybe not this year, maybe not fiscal 27, but definitely by end of fiscal 27, fiscal 28, I think that shortfall will be removed. I mean, reasonably, that is what is right to expect, because that is what has happened in the past. And also remember that this is not a boost in isolation. This is a boost along with lower interest rates, along with improved liquidity for banks and NBFCs, and also that 1 lakh crore which was given as a tax break in the February budget earlier this year. So if you look at all three in combination, I think definitely consumption is going to revive and it's going to recover some of these shortfalls. So I don't think the fiscal impact will be more than 1 2 years.
Okay, so definitely, tax reduction in tax slab is one thing, but there are a lot many other structural reforms are in play, like many changes we have seen on the compliance side and all. How will these reshape businesses, and what's the spillover for mutual fund industry?
Yeah, so automatic refund for input tax credit, automatic refunds have been, I think those processes have been streamlined. I'm not an expert on those processes, but from whatever I could read of all those processes, it is very clear that some of the working capital requirements for the SMEs, for the businesses will come down if these process improvements happen. So clearly, that is important in the current environment when MSMEs were going through a little bit of a slowdown or a risk of slowdown in the export markets, etc. So I think it's from that point of view, it is a good relief for the cash flows of the corporates or of the SMEs, mostly important for SMEs and medium enterprises. There are also, so I think it is not just a rate cut or it's not a GST rate rationalization, but it also a combination, as you rightly mentioned, of the some of the process improvements which the industry has been asking for quite some time.
Okay. Rahul, from CIO's perspective, I would like to understand. Previously we have seen in the last 2 years there was a lot many inflows in specifically in the sector of fund side. Do you see after these reforms, the flows on the sector side will grow? And could it trigger new themes or shift in allocation across sectors and strategies?
See, clearly, even for last 6 months, we have been maintaining that I think the time has come for us to revisit some of the old themes and not worry about what has worked in the past, but look at what is going to work in the future. And consumption as a theme definitely was standing out because the expectations were so low. And starting with the income tax cut and the rate cuts, and now this, I think definitely some of the narrative which was earlier there of only capex or defense or power manufacturing, I think some of that narrative will shift towards consumption. And definitely from a sector allocation or from a sector thematic fund perspective, since we have both funds in our, at least in our basket, Tata Consumer Fund and Tata Banking Fund, I think these two funds should get more, should be in the focus list from a thematic fund perspective. At least as far as sector allocations are concerned for the diversified equity funds, clearly in some of the funds like FlexiCap, we had started moving towards consumption. So clearly, this is something which will give us more confidence to continue on that process and move away from very high expensive thematic sectors of the past, which is manufacturing, defense, to some extent power. I think that thematic shift will definitely happen, like you're mentioning, towards consumption. The other thing to note in the current market condition is that themes are fine, but eventually now most of the themes have played out, except as I mentioned to some extent consumption and banking. But most of the uh, effort or most of the decision making today is more about stock selection rather than theme selection, and I think that is what is the like the last kind of remark I would like to give on this issue.
Okay, interesting. So, Rahul, what should retail investors and advisors watch out for as GST 2.0 rollout? As you know, lot many people are talking about, and there are a lot much talk about this sector will impact it or auto or consumption. So, going forward, what all the things retail investors or advisors can watch out?
So I think we have to be very watchful on how consumption picks up. I think the biggest data point in that will be the festival season. So I think September anyway demand will remain low because GST rates will start only from September 22nd. But I think this Diwali October period is very critical for us to get confidence on the fact that all these measures are resulting in consumption boost. The other thing which we can watch out for is the fact that credit growth in the banking system has been very low, almost as low as 10, 11% or 9 to 10%. Now we get this data; these are high frequency data. We get this data very regularly on a fortnightly basis. Our sense is that we will see credit growth inching up towards the festival season and beyond, and I think that will be a positive change. And I think this is very important for us and the markets and the equity markets and the FIIs, because they would also be watching the impact of these GST cuts on the GDP growth, on consumption growth. And if it starts to show results, then you would see market reacting positively to that.
Okay. So, for investors' point of view, Rahul, any suggestions to reposition, their portfolios post this reform?
Yeah, no, as I said, I think this is a market for flexi-cap funds with a bottom-up approach. That's the point number one I would like to make. Number two is that if investors were heavily positioned in manufacturing funds or defense funds, I would advise them to relook at that allocation and look at some of those sectoral allocations. So, for example, every investor would have, say, kept aside 20% for sectoral funds. I would definitely want them to look at consumer and banking funds for that 20-30% allocation, which they have kept aside for thematic funds into these categories. These are the two things I would like to, kind of leave as a advice for investors or partners.
Okay. So my last question would be, is this a time to, from the investor's point of view, definitely, is this a time, right time to put money in a lump sum, or SIP is the best way to go?
No, SIP, STP is always the best time to go, best way to go, because world is not a very predictable place today. We are looking at multiple events happening in multiple countries, and therefore, while we understand India and we understand the risks pertaining to India and the opportunities pertaining to India, it is very difficult to be 100% right on what's going to happen in the world, and therefore, the best way to kind of protect against any such unforeseen short-term risks around the world is to look at STP or SIP mode as the best way to invest, especially if you're investing in 100% equity funds. If you're not investing in 100% equity funds, if you're investing in balanced advantage fund or multi-asset fund where there is already an allocation of gold, silver, and debt, I think their lump sum can be fine, but not in the 100% equity funds.
Okay. So thank you, Rahul. Thank you for giving insights on the new reform and telling us what kind of a shift we can see in the market. Definitely, हमारा देश आगे बढ़ रहा है, but we have to be watchful what happening across and outside our country as well, and invest accordingly. So thank you, Rahul. Thank you for your time, and thank you, audience, for be a patient listener. Thank you.
Thank you, Ritu, and thank you to all your audience. Thank you.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.